All right, so you're not hearing the commercials, correct?
Correct.
All right, good. All right, 1 minute. All right, 10 seconds.
What's cooking, Gumbo Nation? You're listening to Mortgage Gumbo with Dwayne Steiner right here on iHeartRadio. And I'm your host, Dwayne Stein, the Gulf South Mortgage Authority. And if you're new to the Gumbo Nation, welcome. We're glad to have you here. We think you're going to like it. I mean, we like being here. So, join the party. This is your home show where for 9+ years, that's right, 9+ years, been providing education and options to clients just like you, current homeowners, future homeowners, and just making sure that you have all the education and knowledge you need when it comes to dealing with your largest investment, most valuable asset, your home. If you're new, welcome. Welcome to the Gumbo Nation. If you want to join the show, always an opportunity, 504-260-0995, or you could shoot an email to info@mortgagegumbo.com. On the show today, CPI number came out this week. That's the core pricing and consumer pricing index. And that number was hot. We'll explain what that means. It poo-pooed all over the rates, so we'll explain that. And really why it doesn't matter. And because, you know, I'm from a world of control the controllable. So we'll talk about that. But then also, it's spring buying season. And the mortgage industry has tons of lingo. Just like I'm sure in whatever career you're in, whatever job that you hold, there's certain lingo that if I walked in, you would not be aware of, right? I may have heard something like that, but what does it really mean? So what I want to do today is, it's going to be a classroom today. We're going to have a classroom mentality today, and what we're going to really be breaking down for you is some key mortgage terms that you have to make sure that you know what they are. So we're going to get into that because maybe a lender calls something different. Maybe, when you say, hey, you got to get an inspection, maybe a lot of people think that's the appraisal. So we're going to just explain a lot of key terms. So, and look, if you ever want a copy of all this stuff, I put all this stuff, I have it for you. Shoot an email to info@mortgagegumbo.com so I can be more than happy to help you out. So, jam-packed show, so get your tape recorder ready and excited. So the weather's beautiful. Festival season is here, right? We got French Quarter Fest going on. Gonna have Jazz Fest coming up. The Zurich Classic. So hopefully the weather stays nice. This kind of weather here with this low humidity. If the weather was like that, everybody's like, man, I'd take this year round. Heck, we couldn't afford to live here if the weather stayed like this all the time. Our little best kept secret here in the South would be the cat would be out of the bag, so to speak. So, but want to start the show just prayers and thoughts for those listeners. Got plenty of clients, friends, family out in Slidell. That was horrific. Some of those images I saw, and just the destruction that this tornado came through. I mean, I cannot remember as a kid ever, hearing about tornadoes. Maybe you get a twister after a hurricane came through when those winds turn around. But, now with what's going on, it's crazy. Look, two of the guys I've been working with forever, Jeff and Claude, their mom got hit not once but twice in those storms in Araby. One of my sister's best friends lost a cousin in one of the tornadoes. So, I don't know what it is, but it's crazy. And so my heart goes out to those who were affected by this. So very, very hang in there. But some of those pictures were just horrible. So just, when things hit like this, it's out of control. It's tough. So just wanted to, hearts, prayers, thoughts, all that stuff goes out to the folks there. So, but I'm sure a lot of you like me, look, early 50s, I just do not remember this. And it's bananas. It's just, to me, it's crazy. Don't understand it, but it is what it is. So, anyway, with that being said, so lots going on. Hey, we're wrapping up baseball season. Have a game today, and then this afternoon as Monday, and then fingers crossed, get into the playoffs, and then see where we go from there. So Lakeshore, Coach Sue, Coach Safer, Coletti, Coach Bat, doing a good job trying to get us into the dance, and then going from there. So excited about that. Look, there's a lot right now, and we're going to get into rate watch in the next segment and all that kind of stuff, and we're also going to make sure that we talk about the CPI and everything that's going on with that. But the retail spending came out, and I wanted to kind of share this with everyone, and because when you look at it, consumer spending's still up, and if you listen to the show, or if you're new to this show, of course it's up. Because if they're using credit cards, naturally it's going to be up, right? Right now, things are, it's difficult. Things are tough. And, what's crazy is in March, had a non-store retailers, and that's internet sales, right, was up 2.5%. And for me, I sit back when I see these numbers and I just think I take off my lending cap and want to just be a consumer. And, a lot of that is just the ease now, the world of literally, computers being at your fingertips, right? And you being able to just go online and get what you want a click away. I now hear about how one of the grocery stores now they not only can you have your stuff delivered, but now they'll come in and put it up for you. I mean, you know, do I want a complete stranger in my house? I'm sure they vet them and all that stuff, but man, that to me seems like trouble waiting to happen. But everything is so easy, so at our fingertips right now that it's easy to just spend that money. And credit cards, unfortunately, are almost like monopoly money because it's payment down the road for goods you're getting now. So that was up 2.5. Food and beverage was up 1.2%. Got to survive, got to eat, right? Sporting goods and hobbies was up almost 1%, 0.9. You know, I think sporting goods and hobbies, I sit here and immediately think, all right, what is that? Guns, ammo? You know, what is it cleats? Is it basketballs? I don't know. But sporting goods and hobbies was up 0.9%. Here's what's kind of crazy. And this is in my world, and this is why this kind of sticks out to me when you look. Furniture and home furnishings was down 1.5%. Building and garden supplies was down 2.1%. And then electronics and appliances down 2.3%. So when it comes to the home, when it comes to maybe freshening up a little bit, people are kind of putting that on the back burner because, like we've been talking about, they're in survival mode. And these non-store retailers, I guarantee if they broke it down, even though it's internet sales, a lot of it is probably the toilet papers, the you know, all these kind of things that are necessities to live, right? So when you look at this, there's a lot going on, but that consumer spending, again, continues to be out there. And the reason I bring this up is this is just a measure. This is what they're going to continue to look at, the Fed, in regards to rate cuts and different things like that. Okay, Mother, I forgot to mention, gotta love it, this is live, mention a big strawberry fest this weekend. 300,000 people. You're right. Forgot all about that. Trying to get out there actually tomorrow. So there you go. So thanks, Mom. Gotta love it. So getting corrected. So there you go. Got a little air time too, Barbara. But so when we're looking at that, that consumer spending, look, we're all in every dollar we spend now, we're looking at it, right? We're either saying, gosh, it never used to cost this much, or hey, I've got to have this. This is a necessity to live. So how are you managing that? Are you using a budget? Or are you trying to figure that out? Because as we've talked about on past shows, you got to keep an eye on that debt as well. So we got to make sure that we're looking at the entire picture. So bringing that up there just so you can kind of get an idea of exactly what's going on. So on the other side of the break, war. It's possible. Is it coming down? The June rate cuts, the CPI this week, all those things we're going to talk about and much more. If you've got questions, shoot them over to info@mortgagegumbo.com or give us a call, 504-260-0995. Stick around. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio, 504-260-0995.
Hey, Dwayne.
Yes, sir.
Hey, your mic is way too hot, dude.
All right.
It's popping.
All
just right. when you're you.
Yep. I got you. All right. It's weird. I didn't touch anything, but all right. Is that a little better?
I'm not 100% sure because I can't tell during
Yep.
the break
Okay.
of you and Q.
Yep.
But yeah, it was peaking out every time you just raised your voice.
Okay. And we'll have fun, 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 fun. Fun, fun, fun.
10 seconds.
All right. Thou for summer. Welcome back. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio. 504-260-0995.
Yeah, that's much better.
Man, Dave plays that song, and it reminds me, for a split second, I forgot that my son's a senior and only has 10 days left for school. So thanks, Dave, for bringing me down, brother.
You're welcome, buddy.
Appreciate
you're welcome.
you, man. Can always count on you to help me out here on my Saturdays.
Hey, my son's senior prom is tomorrow. Tonight.
There
My
you
son's
go.
senior prom is tonight.
See, you're going through it too, man. So you're going through it as well. So good stuff. All right, so let's talk about, and if you want to join the show, 504-260-0995, home away from the show, mortgagegumbo.com or snapsendandsave.com. So the CPI came out, and that's the Consumer Price Index. And, we talked about last week was the PCE report. And basically, it came out and it was hot. And what that means is inflation is still showing that it's on the rise. And what that means, people are still spending, right? And the whole point of inflation, they're trying to slow spending down. That's why they raised those rates so high. And at the end of the day, they came out, remember, in December, we're going to have all these rate cuts. And you go back, listen to my shows, go on YouTube, over 650 videos. Go on YouTube, subscribe to Mortgage Gumbo or join Facebook group Gumbo Nation. And we told you can't see that happening based on the data. And everybody, it's election year. They're going to do this. They're going to do that. Well, the numbers just aren't allowing it. And the fact is, what we have going on, I think we can all agree, is not transitory as they discussed, right? Or so to speak. And, proof that they don't know what's going on is before the core price index came out on Wednesday, they were going, hey, a June cut. And I've been telling you, the Fed wants to cut so bad. they really want to cut rates really, really bad because it's political and they see what's going on and it's not good and they really want to try to cut. But the June cut before Wednesday was 68%, and now it's down to 27%, which just shows, and that's the betting person, right? They kind of do that as like, hey, here's the percentages of that. And it's just tough because they're not going to be cutting these rates based on everything that they've got. And we've talked about how, okay, hey, jobs reports and all those kind of things. And as much as we've talked about how they've tried to manipulate those, they can't have unemployment go up too much because then it's not working. If they cut rates, we've got an issue. Well, now guess what happens? Now we've got the Middle East this isn't good. And, this is almost like the perfect storm right now. And we have no reserves because we emptied our reserves a couple years ago, which, by the way, now gas is back up to $87. We can't put our reserves back because at, I think, 79 cents or something like that, they were trying to negotiate. I mean, can you imagine 79 cents a gallon at however many bazillion gallons? So, and now we've got this war. And normally war, you've heard me on here over the last 9 years telling you world strife is good for mortgage rates. And it's because what happens? They start to kind of keep things, they want stabilization, right? They want cash. They want to try to stabilize everything. So they lower things down. They maybe cut rates a little bit or cut back. Well, now where we're at, they really can't do that. So that's why for me, my question to you, Gumbo Nation, is, hey, what if this thing does escalate? What if it's not a tit-for-tat type of thing between Israel and Iran? And now we've already started sending all our munitions and stuff over there. What is that message? Does that mean we're going to be involved? What is going on? So those are all things way above my pay grade, but it's things that we got to keep an eye on because how does that affect mortgage rates? And like I've said, in the past, world strife, not that we want that on anybody, but it's helped stabilize mortgage rates. So we'll see what's going to happen. Personally, what I think you're going to see is this. It was called quantitative easing when COVID came out. And what that meant was the Fed didn't sell any of their bonds. They were holding them all, right? That's why you were able to see rates go down so much. What I think is going to happen is we're getting close, and they're not going to call it quantitative easing because what they're doing right now is the quantitative tightening, right? They're selling the mortgage bonds off so they could get their monies back, right? But how can I sell these bonds back where the rates are? Who wants to buy that, right? Who wants to buy something that they really can't make money on? And knowing that eventually think about it, if they're going to buy it now, you wouldn't be buying a house right now. Let me put it to you this way. Nobody in their right mind would be buying a house right now going, hey, I know the value's going to go down for the next couple years, but let me get it now anyway and I'll hang on till then. No. You know why everybody's still out buying houses regardless of the rates right now? Home values are going up. And it's only going to go up. Like for those folks who are going, oh, I'm going to wait for the rates to go down. Hey, cool. That's your prerogative. You're still going to pay top dollar. And my point being here is when you look at that with these bonds, who's going to go buy these bonds as security when they know that at any moment rates could get cut, different things like that? So what's going to happen is the Fed's going to have to start holding back onto these or buying these things back. But they're not going to call it quantitative easing. They're going to call it, we're the greatest act, everybody needs a break act, we're sorry act, something like that. And then that's where you'll see that 10-year treasury start to kind of go down, and you'll be able to see rates easing a little bit from the mortgage side. Not necessarily the Fed's funds rate, because if they can't cut, they're going to do this bonds, which is going to help out. It's going to help out on the mortgage lending side and try to ease some pain that way. That way, maybe those payments can be a little bit helpful on some of this stuff. Because think about it. All you got to do is look at car commercials, folks. That's all you've got to do. And you'll see 0% financing or 1.9% financing. And we got used to seeing that. But we got used to seeing that for 72 months. Now you got to look at that fine print. You'll see the big old 1.9 or 0.9 for qualified buyers. And then you need to get out like your microscope or your magnifying glass to see for 24 months. Well, look at car prices where they are right now, and that is why you have tightening going on right now in your own pocketbook, right? Because you've got to survive. You need those survival goods. You need your auto to get to work. Some of you need that auto to get to both your jobs, right? 217,000 of them last month alone. People now have 2 jobs. So that is what we have going on. So right now, what they say, if the water's getting hot, you put a turtle in water and I mean, not a frog in hot water, it's going to jump right out. You put it in there and the water's normal and you just start to cook it. I know it sounds a little bit inhumane, but, and you just turn up the heat and it's going to die because it doesn't know to get out. Kind of right now, the temperature's getting a little bit heated. And we're in a situation which is tough. And then you throw in an election year and everything else going on. We're kind of at mercies here. So, look, we'll keep you posted on this stuff. There's a lot going on. I think it's going to eventually you're going to see, like I said, they're going to call it something. And then we'll come back on this show and be like, hey, kind of told you this is where they were going to go. But, hang in there. Look, we're as resilient as anybody. Right, we know that. You know that, especially here in the Gulf South. But so we just got to make sure that we're keeping an eye. And just want you to know what's going on out there. And so now the June cut's off. Now the September cut is at 72%. Right, like what? What do we? I mean, now we're out to September. I mean, I guess eventually it's like that person that goes to the casino all the time. Eventually they win and you see it posted on Facebook, or that's what they talk about all the time. So we just got to see. So keep your eye on that. All right, let's get into our weekly segment we like to call Rate Watch. All right, Consumer Pricing Index came out, and look, on Wednesday we saw, and what I would ask you also is your lender looking out for you? Look, we locked our pipeline. We saw what was coming. We had an idea. We don't like to play like we talk about all the time. The euphoria of the rate going down is nowhere near the joy that you think of the pain that you get when the rates go up. So 30-year conventional last week was 7.01. This week, 7.30. So quarter percent. 15-year, 6.48 last week. This week, 6.75. Quarter percent. FHA, 6.45, 6.70. Quarter percent. Jumbo, 7.32, 7.51. VA, 646, 672. 5-1 ARM, 675, 721. 721. And 10-year. And this is where I hold out a little bit of hope. And I keep telling you, right? So the 10-year, with everything going on, 4.402 was at 4.58, right? So didn't jump quite as much, only 18 bips, as the actual rates on paper look like. So, for us, the rate sheet didn't jump as much as you would expect, right? So when I'm giving you these numbers, these are put out by Fannie and Freddie. These are just, an overcast, right? It's not you directly, so it depends on what kind of loan and all that. But want to kind of give you an idea. So that was only up 18 bips. So that kind of made me feel a little bit better because that 10-year wasn't as bad once we ended the week, right? So now, But if you look at what it was 2 weeks ago, it was at 4.20. So now you're looking at, hey, it's up that 30 bips, right? Almost, heck, 40 bips. So the rates are, we talk about ride the highs and the lows and the ebbs and the flows. And the reason why I tell you really none of this outside of, and it makes a big difference, other than it's maybe affecting the buying power a little bit, but we could show you how to overcome that. Because if you're thinking about buying, nothing I just said, if anything I just said goes up, that's it, not buying, you wasn't serious about buying right now anyway. But for those who are serious, and we continue to see some applications, we continue to see it picking up, right? For those that are serious, you understand, marry the house, date the rate. This is proof of that right now. This is not a long-term thing. So stick around. It's festival season. If you're heading out to one of the French Quarter Fests or Strawberry Fests, let me know. Keep me posted. And hope you're enjoying the show. Crack one back for me. I'd appreciate that. You're listening to Mortgage Gumbo. On the other side of the break, get your pen, your pad, get ready. We're going to be breaking down what are key mortgage terms. You're listening to Mortgage Gumbo with Dwayne Stein right here on iHeartRadio, 504-260-0995. Yes, indeed. We're learning you this morning. We're going to be learning you. That's why we got the Schoolhouse Rock. We got the ABCs with the Jackson 5 going. We're going to be teaching you what are some, sort of giving you a glossary of mortgage terms. And if you want a copy of whatever we discussed today, shoot me an email at info@mortgagegumbo.com. That's info@mortgagegumbo.com, which we got an email over the break. Missy in Orange Beach, Alabama. Nice. What is the difference between a second home and an investment property? Missy, that is an amazing question. Second home is you do not use it, you use it to live. Maybe a second home is you got a condo in Orange Beach, but you don't rent it out. And it's more than 50 miles from your primary residence. That's the key. A second home has to be more than 50 miles from your current resident. Now, or primary residence, I'm sorry, from your primary resident. That's as the crow flies. So you can't live in Chalmette and leave Chalmette, drive through Slidell, go to the Causeway, head back over to Destrehan, then come back around, take the ferry through the West Bank, and then you're home, and then go, all right, well, it's 50 miles. No, it's as the crow flies. So an investment property is, hey, you use that to earn income, right? Specifically. So maybe that condo in Orange Beach that you're looking at, and I'm assuming maybe you're looking at buying, give me a call. Be more than happy to give you a free second look. Save somebody this week a 0.5% interest rate and about $3,000, but that's nor here nor there. But the investment property is, hey, I'm going to rent that out. I'm going to produce income. Whereas a second home is your getaway home, right? I just want to get away, something like that. But it's got to be more than 50 miles. When it comes to financing, sort of a big difference as well. On a second home, you could put down as little as 10%. Now, with where the rates are and everything like that, it's whenever it's outside of your primary residence, they're being tough on those right now. But a second home, you can do it with as little as 10% down. So just so you know. All right. So great question there. So want to kind of get into what some key terms are, folks, because there's a lot of acronyms. There's a lot of things that go on in our industry, and I think it's important that you know what those terms are, right? This is your largest investment. It's your most valuable asset. I think it's important that you know, because there's a lot of acronyms that we use in the mortgage industry, and a lot of times I got to make sure, and I always ask my clients, I'm like, all right, do you understand, and follow up, because I may get caught saying LTV or something like that. So let's get into this. So number one, let's start with rates, okay? So you've got a adjustable rate mortgage, right? And what that basically is, and I'm giving you definitions and everything here. An adjustable rate mortgage is a home with an interest rate that varies during the life of the loan. You also have a fixed rate mortgage. That's the world that I operate in, where a home loan with an interest rate that stays the same throughout the life of the loan. Okay? And then you have what's even worse, and why I cannot stand HELOCs, and I think they're the devil in disguise, is variable rate. That's where it adjusts based on federal funds rate, based on the market, based on whatever the bank really wants to do. That is your credit cards, right? Every month, your payment's different, the rates change, all that. That is a variable rate. So your three types of rates are an adjustable rate mortgage, also known as an ARM, a fixed rate, and a variable rate. Okay? So that leads me to APR, or annual percentage rate. When we are giving you your payment and we're discussing how much your payment's going to be, that is your rate. Your APR, what that is that is the total yearly cost of a mortgage, including the base interest rates and any other add-on loan fees and costs. So every loan has an APR. And I looked at one this week. The client was promising them a certain rate, right? 5.99. Well, he's beating a snot out of what I was offering. But then you went and looked at their APR, and their APR was almost in the sevens because of the amount of fees they were being charged. So even if you don't know anything about this and you're getting quotes, look at your APR to see, are they hiding these crazy fees? People are crafty. Not everybody's by the book. Not everybody's been doing this for 30 years and has an impeccable reputation of doing things right and doing what's best for the client. You got a lot of desperate people in this industry. So you want to make sure you're looking at that before you move forward, because there may be a bunch of hidden junk fees or something like that in there. So again, annual percentage rate is the total yearly cost of the mortgage, including your base interest rate, points, and any other add-on loan fees and costs. Okay? The next term is credit report. I know this sounds simple, but maybe if you're new to the show, what a credit report is, this is a detailed analysis of your credit history prepared by a credit bureau. And so those credit services, you're looking at are Equifax, TransUnion, and Experian. So when we run a credit report, you get 3 scores, and we take the middle score. Okay? Now, with a credit report, you've got 2 types. You have what's called a soft pull and a hard pull. Now, our initial credit report is a soft pull. Or if you're going for a job interview or something like that, that is going to be a soft pull where there's no inquiry that hits your credit report or has any effect on your score. Then you have the hard pull. This is when a decision is being made on lending. You go get your credit ran to buy a vehicle. That's a hard pull. You go get your credit ran to get a new credit card or a new loan, installment loan. Those are hard pulls. When the ultimate decision is being made on buying the home and doing a mortgage and moving forward, then we do the hard pull at that point. Okay, so there's a big difference there, folks, because I'm amazed on how many people will call me and go and love the fact that we'll do the soft pull while we're doing the initial approval, but then they'll have somebody else pull a hard pull. Well, that changes things sometimes. So just be careful there, soft versus hard, okay? Now, when you're dealing with credit bureaus, the next thing is debt to income, or DTI, right? That is the percentage that compares your monthly debt to your monthly income. Simple enough. But as we talked about my man Andrew Makovich this past Wednesday on Mortgage DNA, we broke down what is DTI, and there's a front end and a back end. Your front end is just your housing expense by itself, okay? Which is also known as PITI, principal, interest, taxes, and insurances. And then you have your back end, which includes all your debts, including your new housing ratio, plus any credit cards, any installment loans, student loans. It does not include, even though you may have an auto payment, it does not include your auto insurance, your cell phone bill, any utilities. It does not include that. I know a lot of you sit on the sidelines sometimes because when you're going through your debt, you're like, oh my gosh. And then when you speak to me, I put you at ease because I'm like, we don't even have to count all that. So there may be a lot of things keeping you on the sideline right now that you really don't even have to have. Okay? So we talked about that there. Debt to income ratio, DTI, and then we threw in PITI as well, which is principal, interest, taxes, and insurance. That's your loan payment in total. That is your loan payment in total. Okay? And then you have FICO score. We'll do this one, then we'll head to a break. FICO score, this is the nation's most widely used measure of credit risk, calculated by the information on your credit report. So when I go, hey, your scores is 722, Your mid score is a 722. That is your FICO score. There's thousands of scoring models out there. You get the free stuff in the mail or that you get from your bank and all that. Well, a FICO score is what 99% of most lenders use, is the FICO scoring model. So again, hey, we're just here. We're giving you some key terms so you could be made aware. On the other side of the break, we got plenty more to get to. And we just got a great question about buy down that just came over. So we'll answer that question as well. You're listening to Mortgage Gumbo with Dwayne Steiner right here on iHeartRadio. Stick around. We're going over key mortgage terms. We're educating you today, folks. See you on the other side of the break. Join the show 504-260-0995. Oh yeah, that gets the feet stomping, a little knee slapping. Man, that's a good jam. Good job there, producer Dave. Welcome back. You're listening to Mortgage Gumbo with Dwayne Steiner right here on iHeartRadio. Hey, if you want some more of me, excited, stick around next hour. Be joining Gregory Ricks on Winning at Life. Excited, love being part of his show every single month. And then you really want to get crazy? You want to hang out with me in person today? When I get done with that, come on over. Hosting a open house with Patsy Miller, 467 Red Maple Drive over in Mandeville. Come on by. Got some Mortgage Gumbo swag over there. Come on by. Come check out this awesome property that we are going to be having an open house with Patsy Miller. So excited about that. All right, let's jump back into some of these key terms here. And a mortgage. Well, what is a mortgage? Well, by definition, it's a loan used to purchase a property that is paid back over time. That's what a mortgage is, okay? Now, before you get that mortgage, you got to know there's two things. There's a pre-approval versus a pre-qualification. A pre-approval is a written evaluation based on the application that determines your specific approved loan amount. A pre-qualification is verbal. Verbal. So be very careful there. Very careful there. So many folks call me after the fact and a lot of it's sellers and listing agents who are like, can you call this buyer that I accepted a contract on who now all of a sudden the underwriter's saying we can't do something? You got to be able to know. We won 2 contracts this week because our clients did not have the best offer. But you know what they had? They had a pre-approval fast track that I was able to attach a $5,000 guarantee. If you are a seller out there, you need to be asking your listing agent to get with me to find out how does that work, because we're guaranteeing it and we're closing them in under 20 days. So you want satisfaction like we talk about. 4 Ds, right? Death, divorce, debt, and distance. That's a lot of reasons why folks are selling. All right? So, now, what is the principle? What is principle when it comes to a mortgage? This is the amount of money borrowed or remaining unpaid. Your balance, right? You have a balance. So if you borrowed $100,000 10 years ago, well, now maybe your principal balance is $52,000. So that is your principal, okay? So you got to be aware of what that is. Now, what else do you have when it's coming to the mortgages? Some of these terms here, okay? You also have a couple things you want to, and this is going to lead me into my question, my question I got over the internet, is you have origination fees. This is a fee that you pay to your lender, right, for processing a loan application. All right? So nobody out there works for free, so you'll see what's called an origination fee. Do not let that be confused with points. With points. Points are a type of prepaid interest, right? A prepaid interest that you could purchase to cover your loan cost or lower your interest rate. Now, there's a big difference because this week there's a lender out there that's selling buy downs but really giving you a discount point, and there's a big difference. So, question came over from Mike in Laplace. What is a rate buy down? Well, there's a couple. There's a 3-2-1 buy down, a 2-1 buy down, or a 1-0 buy down. But what a buy down is whatever rate you qualify for. Let's say it's a 2-1 buy down. So I've got a client that I'm helping right now in Lafayette. They've got a 6.875 rate. The seller is doing a 2-1 buy down for the client. Okay? So their 6.875, their first year it's going to be 4.875. Then 12 months later it's going to be 5.875. Then it goes back to the original 6.875. So that's what a 2-1 is, right? It changes twice every year till it gets back to the original. If you have a 1-0 buy down, then that 6.875 would go to 5.875 for a year. These are something that I've been offering for 20 plus years. They've become a little bit more popular with the rates being a little bit elevated, even though people understand that they're going to refinance when the rates go down. If the seller's paying these, there's some options there that you can look at. The sellers, the builders. So there's a big difference there between points and buy down. So be careful, because like I said, a lot of lenders right now are trying to sell a number on a piece of paper. But you got to make sure that you're looking at it, because they're selling, oh, I'll buy down your rate. Okay, buying down your rate is a big difference than giving someone a discount point. So that's why I want to make sure. That's why we're doing this, to make sure that you're educated and you can ask that next question. Okay? PMI, private mortgage insurance. This is money to protect the lender in the event of a loan default. Typically only charged when a loan value is greater than 80%. Folks, we're now offering, you talk about there's a lot of folks out there not want to do business. We're now offering no PMI loans at 85%. And a lot of you that have been listening for years understand, and who've worked for me for 20 plus years, I've been buying out PMI with 3% down. But we're not in that environment right now because we know a refinance is going to come out. So let's talk about that. Don't let PMI be something that's keeping you on the sideline.
2 minutes.
Appraisal. This is a written estimate of the value of a property. If you're financing a loan, you're going to need an appraisal. But I want to make sure you do not confuse an appraisal with an inspection. An inspection is something you normally do before you order the appraisal. And this is that you have a third party come in, looks at the house to see what is the house, if there's anything that needs to be repaired, if it's as good as advertised, is it lipstick on a pig, what is it? But I want to make sure that you understand an inspection is not the same as an appraisal, okay? An inspection, while recommended, is not required. If you're financing, an appraisal is required. Then you get your appraised value. This is a professional evaluation of the property's fair market value.
1 minute.
And the beauty of that is that fair market value will then lead to what, hopefully it's what you're paying, or if you're refinancing, what you're hoping the value of the property is. And that will then give you your LTV, or loan to value. That is the amount of your mortgage divided by the appraised value. So if you appraise for $100,000, you're buying it for $80,000, your loan to value is 80%. You've got 20% of equity.
30.
Equity. All of you have more of it than you've ever had. That's wealth. That is how much money your home is worth versus
20.
what the balance is. Stick around, folks. We'll be on Winning at Life in the next hour. Till next week, Gumbo Nation, keep stirring the pot.